Hey everyone, in this video I am going to walk you through the pro forma for multifamily renovations. As with all the other videos that I do, usually with model walkthroughs, I'll do a high-level overview of all the tabs, and then we'll go into each tab and we'll talk a little bit about the functionality. So yeah, without further ado, let's just dive right in. So this model comes with 7 tabs. You have your summary tab. And you'll notice, as usual with all models, the cells with the blue text are where you put in your inputs. So there's some inputs on the summary tab. We have our global assumptions tab here. And within that, we have some income assumptions, we have some inflation assumptions, and OPEX inputs. We have our unit details tab, and this tab I'm really excited about, and we'll go through this in quite a bit of detail. There's a lot of functionality here, and really what I think is the power behind this model is that it gives you the ability to phase in unit by unit. So you're able to go through, if you don't want to renovate all the units at one time and you want to do it in phases, this gives you that ability. If you have, custom plans for each unit, you're able to model that out here. So it's a really, in my opinion, a great tab. So excited about it. Next one is global, non-unit related capital improvements, such as like roof, landscaping, anything else you might have. And this gives you the ability to do 6 capital improvement projects. We have our annual cash flow tab, no inputs here, just a roll up of the monthly tab, which again also has no inputs. And then the last page is the waterfall tab. And this waterfall, I'm not going to go through it on this video because this is the same waterfall model that we use in the condo development model. And so if you want to learn about it, you can just click the link that's up here in cell E3. I added a couple new things here. I added the GP fees section. Actually, I think that might be it. And that flows in right here. So again, a couple inputs here to dial in all your partnership splits and how you want to structure that. All right, so let's head back to the summary tab and we'll go through in a bit more detail. So starting at the top left, you have your general info. This is where you put in, if your property has a name, you can put in the project name, address, city, state, and then the version. If you're sharing this multiple times and updating, you'll want to keep track of the version that you're sharing. We have our timing section, which you have your acquisition start date, which you can put in your month and your year. You have your hold period, and you can hold up to 10 years in this model. We then have our exit date. And then below that we have our renovations. So this is really, it pulls out the minimum date between the unit details section for renovation begin date and the renovation begin date for the non-unit capex. And it basically just grabs the minimum of all that. And then with completions, it takes the max of date completion for all of these. And so that's what rolls up here into the summary tab, and then you get your total time. Below that, we have our purchase price. So you're going to manually dial that in. And your immediate capex, so what this does is this formula basically matches anything in the unit details tab that matches the start date with the acquisition date. So you'll notice here we have where is it? Right here in column L, you'll see we have 4 units that are going to go under construction at the start, each one of which is $15,000, and then the rest are $10,000. The next 3, so that should equal $45,000, which you'll see here. And then immediate capex for building non-units, there's $40,000 worth of projects that start at that time. So you'll see here we have 2 that start August 1st. Both at $20,000. Now, that's how that works. If you have a bit of a nuance where maybe you don't want to fund all of that through the acquisition at the time of acquisition, because what happens here really is that the loan amount includes these immediate capex. So if you don't want to include that, what I would recommend in the model is just changing the start date just 1 month later. So rather than start it in this example in August, you start in September. And that'll remove, and I can show you, that'll remove that amount from that. So that 15,000 should be gone, and you'll see there that it is. So that would be my recommendation if you don't want to include it in the debt. Then below that, we have our closing costs, which then brings us to our total. So down to debt, again, we have our loan to cost. And then this is a cool little feature for this model. So you have the ability to utilize 3 different loan types. So this one, which is the most typical, is interest only until it's fully funded. So you're just paying interest only, and once all the loan amounts dispersed, the loan will start amortizing. We have stage funding, which basically the loan amortizes from the start, the second you buy the building. Let's say, for example, it's a 360-month amortizing loan. Well, if you're taking out money from, months in the future, like let's say the second month you take out more money, well, rather than that money starting amortizing over 360 periods, it'll amortize over 359 periods, so that the max amount of time the money's out is 360 months, regardless of how much is being funded after the initial funding amount. So that's stage funding. And then the last thing, you have the ability to just disperse it all at once. So, maybe you have some type of structure where you just want to get it all out at once, and you're able to do that and want to do that, you have that ability. All right, below that, you have the loan amount, you have your interest, your amortization period, and then you have your loan costs. Here you can just dial in whatever you want. I just did 2%, but you might want to dial in whatever you feel is appropriate for your project. Loan proceeds, and then loan repayment at exit. And below that, you have your minimum debt yield and your minimum debt service coverage ratio, and this is calculated down at the bottom of your annual cash flow. So you'll see the debt yield and the debt service coverage ratio, so that's pulling from there. Then we have our exit cap, sale price, and then sale costs. And you could just dial in whatever your sale costs are. All right, so to the right, starting in column E, we have our returns, and we have our typical project level returns, and then our partnership level returns. Below that's our annual cash flow summary. So this takes really just the major line items from the detailed annual cash flow tab and sums it up right here for an easy view. And then to the right here, we have our unit mix summary. Here, all of these will pull in from the unit details tab based on what you select here in column E. Now you have the ability to update here. I have studio 1 bed, 2 bed, 3 bed. If you want to change penthouse to 4 bed, for example, or actually before I do that, let's keep it at penthouse. And you can check the drop down here. You'll see studio 1 bed, 2 bed, 3 bed, penthouse. And then by changing this to 4 bed, you'll see the drop down menu here change to 4 bed. So I think that's everything on the summary tab. All right, so let's move on. So next we have global inputs. And at the top, we have our global input assumption. So here you have your average lease term. You can put 12, you can put whatever you want in. I have 12 months here. And this flows through the monthly cash flow tab. So if you have an average 12 months, it'll assume that there's a 12-month lease in place. And then you have a renewal probability. And then after that 12 months, it'll factor in this percentage. It'll calculate basically the probability of renewal, and that gets calculated into the formula as well. So what I love about this model is that you have the ability globally to say, for everything in this box here, from renewal probability all the way down to other income, you have the ability to customize the scenarios for pre-renovation and post-renovation, and that'll flow through to each model regardless of when that unit is being updated. So if you have a 60% probability of renewal for a unit and you remodel it this year, and then your assumption is that after the renewal probability will be a lot higher at 75%, that unit will change at that time once that unit comes back into circulation. And then if you have another unit that goes out the next year, that same assumption will apply, and you just dial it in right here globally. So your renewal probability pre-renovation, post-renovation, your rent concessions pre and post, and then other income. You could change these to whatever you want. I have 5 options here. I just have rubs, laundry, you have parking, whatever else you need, or you can just leave it blank. And then a general inflation that you can add to the other income as well. So below that, we have detailed inflation. You have rent growth. You can plug that in for each year. You have general vacancy, and you have credit loss. Now, with rent growth, the interesting thing, so what you can do in unit details is you can add a premium to the rent after renovation. Now, you can't really do that in this model after you do a major capital improvement at a global level, but the goal obviously is to maintain the building, and some of these capital improvement projects may be with the goal of increasing rent. And so what you can do here is if you have a project that's done in a certain year, like an example here is 2023. What you could do then is come in 2023. Maybe what I'll do is I'll actually add the years here below. So 2023 is year 3. But what you can do here for rent growth is maybe you go to year 4, and rather than it being whatever the general market assumption is, you might do like an increased bump here, because what you did should increase the rent so across the board, and so therefore you might want to do a global rent increase that's a bit higher in the year after. So that's how you might want to consider that when you're doing these global capex projects, or consider working through that scenario for the goal of increasing rent due to a capital improvement project that's global for your property. And below that, we have our OPEX inputs. Here you'll put in your year 1 amount, and then you'll grow. You have the ability to grow each year thereafter, and it's all the same all the way through. And so that is the global inputs. And then the next we have unit details. So this tab's really cool. You have the ability to add up to 100 units. And depending on what you put in here, this will open up accordingly. Let's stick with 10, and then we'll walk through each of this. So in this column D, I have unit number. You could have, depending if you have a couple buildings, maybe you have A1, A2, A3, B2, B1, B2, B3, or however you want to name them. If you want to name them, you can add that here for the unit number. And then beds, we went through this. This is the drop down. Baths, there is a drop down. If you want to get in more details, you can put whatever, how many baths are in each of these units. Square footage. And then we have a model unit, and we have this both for before and after. So I'll show you real quickly if we go to the monthly cash flow tab. And let's actually go to unit 2, because you'll see we have before renovation, the unit comes out. We have after renovation, it comes back in now. Let me show you what happens if we say this is a model unit. If this is a model unit, that means there's no rent coming in. It's just there for show and display, and so you're not getting any of that revenue. So it all turns off. Now, the rent is still coming in after renovation because this becomes no longer a model unit. But if we did want to make this a model unit after, you'll notice it all turns off. So there's no revenue coming in from that model. So maybe the likely scenario is you do a renovation and then you want that one to be a model unit, then you could just turn off or say yes that this is a model unit, and that'll work that way for the after. So we'll leave that as is. Next is what in-place rent is. And then you could, this is a global thing. Are you remodeling this? Yes or no. So if you click no, and maybe what I'll do later is do a conditional formatting that just blanks this all out, or just puts a black bar over everything. So if you say no, what'll happen is the cash flow the formula will ignore everything here, and it'll just focus on what's here and what's in your global inputs, and it will grow continuously. So you'll see through, I think it's a 6-year hold, so it shouldn't be that far. There's no spike. It's just a regular rent bump with all the assumptions in there. I might as well put that back to yes. Then we have our renovation beginning date, how long the renovation takes, cost. Again, is this a model unit, which we talked about? So you'll see 15,000 here. You'll see it's over 2 months. So you'll see that broken out into 2 in the monthly cash flow. So let's go. We should go down to capex units. And you'll see here, it's broken that unit down to 2 months of paying out for that unit renovation. And then a lease up after completion. So you'll see there it's been a total of 4 months that this unit is out of circulation. Let's put this no. And the reason is I want to show you that this indeed matches 4 months. So you'll see it starts in May 1, ends in August 1, and then it comes back on in September. And so you'll see this comes out May 1, and then the lease starts in September. Okay. Then we have our premium added due to the renovation. And that should be $250. And it also captures inflation. So it's basically in today's dollars. So, if your rent's growing, it'll still be $250 solid. The $250 doesn't grow with inflation, but the rent may grow. So you might take it out at $785, and then there's an inflation period. The rent will be a little more than, a little more than $250. And the last line item is, or last column is, rent per square foot post renovation. So you have pre and then post renovation. Okay. Non-unit capex. Again, you have up to 6 projects you can work on, and it's fairly straightforward. Your project name, begin date, end date, and then cost. And here's where I talked about premium added due to renovation. Use the rent growth section, the summary tab, which we talked about previously. And then the next section here is the annual cash flow tab, and you can look through this. You'll notice we have our gross rent, we have concessions, and here's our other income with the 5 line items. We have our effective gross revenue calc, so gross revenue, general vacancy, and credit loss. And then we have our expenses, controllable and fixed. NOI, here's our major capex, so capital expenditures, major capex projects that are units and non-unit. Cash flow from operations, debt service, cash flow after finance, and we have the loan proceeds and loan repayment, and then disposition details. And then below that, we have our unlevered and levered cash flows, and then some metrics, free and clear, return, our cash on cash return, debt yield, debt service coverage ratio. And then below that, we have our LP and GP cash flow. All right, monthly, this gets into a lot of details here, so I'll just open everything up, and you can see it's been a lot of work to get this going, just to be able to get the nuance of taking units in and out of circulation. So I hope this really adds value to some of your guys' projects. For me, I find this incredibly helpful. So again, I won't go through all the details here, but you can pile through. Some of these formulas are rather large. So if there's anybody out there that wants to get creative and think of ways to shrink these formulas down as well, happy to entertain those and update the model with those ideas. And the last piece, is the waterfall. So that's really everything. So that was hopefully about 20 minutes. So hopefully it wasn't too painful. And yeah, I hope you enjoy the model. That's really everything. And, please feel free to leave comments, or better yet, try to get in touch through the website, adventuresinsyria.com. And I hope this was helpful. And I will see everyone next time. Thanks a lot.